Hello everyone. As you know, the modern day business is all about credits. No businessman can do their business. No businessman can continue with their business in the long run if they don't resort to the credit either from the financial institutions or from the banks or from the individuals or from the debenture holders. So there are multiple mechanisms through which a businessman can procure, the finances for doing their business. So today we'll be just talking about a very simple term that is the term interest. So what exactly the interest is, how it is charged, why it is charged, and do you think that the total amount of money that you receive in the form of interest is totally your benefit? Your means when you are a lender of the money. So anybody who is lending money to somebody, the total amount of money received in the form of interest, is it his total benefit, or there are various elements associated with that? We'll try to identify on all those points, on all these aspects relating to the interest, why somebody should pay interest, why somebody should get interest, and what are its associated concepts that we'll be trying to discuss it today, so that you also generate enough interest in the topic interest. Okay, so hi, I'm Professor P.K. Pathak. Today again I'm back with a very interesting topic. The name of the topic itself is interest. So hopefully you'll be having a lot of interest to watch the video right from the beginning till the end, so that you exactly know what it all envisages in the process. Okay, so let us share the slides. Okay. So I hope everybody can see the slides. This is the topic of the day. The concept of interest. And again, before starting the topic, I'll urge to do like, share, comment, and subscribe to my YouTube channel and keep on receiving this kind of interesting videos. Okay, so without wasting time, we'll go ahead with the topic. What is the meaning of the term interest, and why somebody should get it or somebody should pay for it? So basically, what is interest? All of you should know that if somebody is borrowing some money from somebody, as you can see here, a payment made by a borrower to the lender of the money is expressed as a rate percent per year. So if you're a borrower and if you're borrowing money from somebody, you must pay him something over and above the actual in terms of the principal. And why you should pay? We are just coming in the following lines. So this is expressed as a rate percent per year, maybe 5%, maybe 10%, maybe 20%, depending on the case-to-case basis. So before we proceed into all those things, let us know the two views regarding the interest paid or the charged. So the first view is from the debtor's point of view. Why the debtor should pay money in terms of the interest to the lender of the money. And before that, let me tell you what is a debtor and what is a creditor. So basically, debtor is a person who has borrowed money or intends to borrow money from somebody who is able to give it. And creditor, as of now, you just think of the one who is lending money. And for further details, I think you have to go into the accounting and financial management class. But as of now, I hope it is okay. The meaning is very clear to all of you. The debtor is one who is going to borrow the money. Creditor is one who is lending the money. So from the debtor's point of view, why he should be giving some charge in the form of interest? Because he is using the capital. The money received by him is used for further production, and he is generating some additional income for himself just by making use of the capital that has been taken from the creditor. So since he is generating a lot of income out of that capital, he has to give a part of that income to the owner of the capital. That is one. The second one is reward for risk. So since a lot of risk is involved in borrowing and lending process, and who is at the risk? Risk is for the lender, because he may not receive the money back for various reasons. So the debtor has to give a reward to the lender for taking the risk and giving money to him. Then the third point is reward for inconvenience. You see, the lender is a person who is making himself inconvenient by not being able to use that amount of money which lies with him. And rather than that, he is trying to give it to somebody else who can make use of it and generate revenue. So for the kind of inconvenience that he has caused to himself, he must be paid in terms of interest. Okay, and also there are certain expenses if somebody is in the business of lending money. So for that also he has to keep certain staff or certain office and the related equipment, and there is a lot of expenditure in that. So in order to compensate for the expenses in the relation to management of business also, the interest is supposed to be paid. So this is from the debtor's point of view, why the debtor should pay interest. And let us now come to the creditor's point of view, all clubbed together. We already had discussed that as the creditor has taken pain in saving the money, otherwise he could have spent on himself and enjoyed the life, but he has taken pain to save the money. He also has suffered the inconvenience in postponing his needs, so he will not be spending on his needs. Rather than that, he has given loan to somebody. And also he has taken a risk of bad debts. So what is bad debt? In case the borrower has been flying off like Vijay Mallya did. He borrowed money, some 9,000 crores of money from the SBI, and he flew off. So that is the risk. Even these big financial agencies, they could not avoid it. So what about the common people? So these are all some of the reasons why creditors should get the additional amount of money in terms of the interest. Okay. So let us go ahead now. These are some of the factors influencing the rate of the interest, because you must be confusing a lot, because in the market there are various rate of interest. If you go to the bank, you will find that for fixed deposits also there are various rate of interest on the periodicity. I mean, for 2 years, some different rate of interest. For 5 years, some different rate of interest. On the recurring deposits, they have a different rate of interest. So similarly, all those finances also they're having different rate of interest on the basis of their own apprehensions. So these are some of the factors. One is the different type of borrowers. Borrowers have got different kind of needs, and then there are people who need to borrow some huge amount of money for a very short period, because they are going to gain a lot by just making use of it for a couple of days or for a week or two. So this basically happens with the people who are into export-import business or dealing with a bigger project, government project, or the jobs of similar nature. So depending on their own requirements, they'll be ready to pay even higher rate of interest if in case they can get it. Then the second point is money market is not homogeneous. So money market is wherein there are banks, there are financial institutions, there are individuals, there is some unorganized community also. They are into the market, money market, and therefore, depending on their own perception of the risk factor involved and very other associated factors, they'll be charging the rate, a different rate of interest. Period of loan, yes, it also has an impact on the rate of interest. If you are taking a loan for a longer period, definitely the rate of interest will be low. Nature of security is another important factor. If there is a collateral, there is a guarantee, then the rate of interest could be lower. But in case of lesser security, or for example, you take the personal loan. So for the personal loan, there is always a high rate of interest. Goodwill or credit of the borrower. If the borrower is having a goodwill, I mean, he has been given credibility for being an honest, repayer of the loans. So on the basis of that, the important is the banks are taking the civil scope of all of us while extending the credit facility. So this also depends. Amount of loan. If you are taking a higher amount of loan, the rate of interest will definitely be lower. Then another factor is interest policy of the monetary authorities. And who are the monetary authorities? The central bank of the country. In our case, it's the Reserve Bank of India. So you might have heard about the repo rate and reverse repo rate. What is the repo rate? Repo rate is a rate of interest through which the Reserve Bank of India is extending loan to the commercial banks running the country. Okay, so on that basis, the banks will be charging a certain rate of interest from their customers. And what is reverse repo rate? It is the rate of interest being paid by the Central Bank of India to the commercial banks for depositing their amount in the central bank. So this interest policy also has a lot of impact on the prevailing interest rates. Difference due to distance, so people prefer, to extend loan to the people near home, even at a lower rate of interest, rather than getting a very high rate of interest from the people who are away from their home. And then finance market are also not perfect. And since the markets are not perfect, every agency will have their own priorities and their own perception relating to the risk factor and other societal things. And so therefore, there is always be variation in the rate of interest. And finally, the differences in productivity. If a borrower feels that he can be productive in the real sense by borrowing certain amount of capital, he must be ready to pay even double of the rate of interest that is prevailing in the market. So it also to some extent depends on the level of productivity that is expected to be produced by making use of such capitals. So now let us further see what are the components of the interest. You see, these are all the interest rates components. You can see one is the risk-free real, other one is inflation premium, and the third one is risk premium. And we'll be discussing the following slide what all these actually mean. So if you have got a pen and paper, you can just make a note of the important points associated with that. Okay, let us now see the risk-free real. This reward is you get for sacrificing the current consumption, that is a risk-free real rate of interest. Okay, so you just try to sacrifice your current use of the amount, and this happens when you are putting it into some government security or something where there is no risk at all. Okay, so you will be getting certain rate of interest which will be quite minimum, say for example 3%. That is the risk-free real. There is no risk involved in it. And further on this basis, we have got certain types of interest. So there will be having more explanations of all this. And the second one is inflation premium. So this is the reward which you are getting for reduction in the purchasing power. So all of you know that आप सभी जानते हैं कि महंगाई बढ़ती है, something of that nature. People keep on talking. Some of them they may not exactly understand what is happening. So ultimately, what happens is the purchasing power of your money is going down day by day. So that's the reason why you say sometimes that 5 years back, whatever you could buy in ₹100, now you have to pay ₹200 for that. So that means the purchasing power of the money has gone down. So suppose the lender is receiving his money back after a certain period of time, the purchasing power already has gone down. So the amount of interest will also include the reduction in the purchasing power of that value. And so therefore, higher the inflation rate, the higher the inflation premium. Okay. So usually all of you know what is inflation rate, and accordingly the inflation premium can be given to the individual. And then there is third aspect, and that is the risk premium. Like I told you, the people who has taken loan, they may run away, like Vijay Mallya's and Modi's and many others like that. They have they have left the country, and the institutes, the financial institutions, they are just suffering because of that, and indirectly we are also suffering because of that. Okay, so for that risk also there is has to be some risk premium. So the rate of interest is also including the risk premium for that. Okay, so these are all basically the three components. So like it has been told, risk premium depends on the security cover that is offered. So maybe 2% risk premium. So altogether, if you can see, 3% is the actual rate of interest, 5% is because of the inflation. So 5 plus 3, 8, and 2% is the risk premium. So altogether, while it may seem to be very lucrative that you are receiving a 10% of the rate of interest, the real rate of interest actually happens to be 3%. The 5% is going for the inflation premium, and so it will not be having a lot of impact on the amount that you receive few years down the line. And 2% is because of the risk. And here is point to be noted is that there is no default risk when the issuer is government, and so therefore you will be losing out this 2% when you are investing in the government. Okay. So on the basis of this, now we have 4 types of the rate of interest. So let us see what all these. Okay, so this is the bottom line. So risk-free real, first type. The second one is risk-free nominal. The third one is risk-adjusted real, and the last one is risk-adjusted nominal. So let us see it one by one. What exactly they mean? Let us first discuss the risk-free real rate of interest, which we have, assumed to be 3%. So this is basically the government securities. People invest money, and they're also inflation protected. So whatever is the change in inflation, I mean the increasing rate of the inflation, that is adjusted apart from the over and above this 3% which is being offered by the government agencies. Okay, so the inflation will not have any impact because the government agencies are all very mindful for that. And also there is no risk premium because these are only sovereign papers. Default risk is zero. In being government agencies, there is no risk as such. So what the reward and investor is getting is only RF real, that is risk-free real 3%. Okay? The total return is 3% plus inflation adjustment. So inflation adjustment, you have not actually have impacted yourself. The real rate of interest that you receive is only 3%. So now let us see to the next type. Risk adjusted real plus risk premium in case of a corporate inflation protected security. So rather than the government agencies which are giving you comparatively low rate of interest, if you decide to put into the corporate securities, which are inflation protected, okay, but they carry a lot of default risk because they are being issued by the corporate, which is not a sovereign agency. So what is the total reward that you receive as an investor? It is the RF real and the risk premium. Okay, so RF real is 3%, already all of you we know it, and risk premium because it is not a sovereign paper. So let us say for example 2% the risk premium. So total return we get 3% RF real plus 2% risk premium, 5% as we can see, plus the inflation protection that is also there in the corporate security. So inflation protection will always be there, but over and above you'll be receiving only 5%. So this 5% includes the 3% of the RF real, risk-free real rate of interest, 2% for the risk premium. Okay. So I think you are having clarity on all these topics. Actually, the third one we'll see is the risk-free nominal. So in this, there is a treasury security, that is the government securities, but they are not inflation protected. So if some investment is not inflation protected, there has to be certain inflation premium as well. So what you are receiving here is the RF real and inflation premium. And again, since there is no risk involved, so no risk premium, zero. So what you receive here? You receive here 3% of the RF real and 5%, say for example, the inflation premium. The total return, it may seem to be 8%, but again, in real terms, you are just getting 3%. Okay? And now let us see the fourth and final one. Risk adjusted nominal plus inflation premium plus risk premium. In case of the corporate security, which is also not inflation protected. So what will happen there? What is the total reward that you receive here? You receive here RF real, risk-free real, that is 3%. Then you also get inflation premium of 5%, so 8%, and the risk premium of 2%. Okay, risk premium of 2%. So total return seems to be 10%, but again, if you recalculate in the real terms, you're just getting 3% plus 2% of the risk premium. Okay, because the 5% is the inflation premium, which actually will not have actual impact on the purchasing power. So that's all for the day. I hope you might have generated enough interest in the topic interest, and you will carry some of the knowledge received from here and make use of it while investing your amount of money in various agencies with banks or the financial institutions, or even for going to the shares and debentures. And in case some of you do not know what exactly the shares and debentures are, don't worry. In the next very video, I'll be talking about the shares and debentures and preferential shares at length. So I hope you have got enough clarity now on the term interest, and just do not get carried away by the high rate of interest and having a misunderstanding that the total rate of return that I'm receiving is my benefit. Okay, so on that note, uh, now I stop sharing this slide, and I thank all of you for watching my video so interestingly. And the topic itself also was on the interest only. So before parting, let me again urge all of you to do like, share, comment, and subscribe to my channel. And very shortly, I'll be back with the proposed video on the share capital, debenture, and the preferential shares, the portfolio analysis. So all these things, this will be quite useful to for the people who are pursuing MBA either from our own country or from abroad, any country. These are all the topics closely associated with all the MBA curriculum. So in case you are an MBA student, definitely you can continue. You can subscribe to my channel, and you'll be much benefited by uh, just following me. Okay, so on this note, now I conclude for the day. Once again, I thank all of you for watching my video. Have a nice day.